Welcome, everyone, to the very first episode of Bull and Bloom. I'm Max, and I'm really excited you're all here to join us for this deep dive
And I am Ella.
into the world of finance and investing.
Thanks for having me, Max. Yeah, I'm excited to really just unpack some fascinating information today.
Yeah, okay, so for our first deep dive, we're tackling a topic that seems like it's on everyone's mind these days. Um, the U.S. national debt and what it all means for investors. We've gotten some really interesting research and analysis from you, our listeners, and
Yeah.
we're here to break it all down. So is the U.S. debt really a ticking time bomb? Should you be hitting that panic button on your investments?
Yeah.
Let's find out.
It's a very hot topic, and I totally understand why. I mean, the numbers can seem, pretty daunting.
Yeah.
But I think the important thing here is to look past those headlines and really dig into, like all the nuances of the situation.
Right.
Sometimes those scary headlines don't tell the whole story.
Exactly. That's what we're here to do. So before we get into the nitty-gritty, maybe we should start with some quick definitions.
Sure.
We're talking about debt, but what about the deficit? How are those two things different?
That's a great place to start.
Yeah.
So the deficit is basically the government's annual shortfall. It's the difference between what the government spends and what they take in as revenue each year.
Okay.
Think of it like your monthly credit card statement.
Mm-hmm.
So the debt, on the other hand, is an accumulation of all those deficits over time, like the total amount that the government owes.
Okay.
It's like your total credit card balance.
Okay, so the deficit is the flow and the debt is the stock.
Exactly.
That makes sense. Now, one thing I thought was really interesting from the research our listeners sent in was the breakdown of who actually holds all this U.S. debt.
Mm-hmm.
I think a lot of people, when they think about it, they just assume that it's all foreign countries, but that's not the whole picture, is it?
Not at all. A big chunk of that debt is actually held domestically. In fact, the U.S. government is the biggest creditor.
Wow.
Through things like Social Security and other government trust funds. This is what's called intragovernmental debt, and that accounts for roughly 28% of the total.
So it's like the government borrowing from itself?
Yeah.
That seems a little strange.
It might seem odd, but it's actually pretty common practice.
Okay.
And then a significant portion, about 39%, is held by the public, which includes individuals, businesses, and importantly, the Federal Reserve.
So when we talk about the U.S. debt, it's not just some faceless entity out there, right? There are real people and institutions on both sides of the equation.
Exactly. Now, foreign investors do also hold a considerable portion. It's about a third of the total.
Okay.
But it's crucial to remember that investing in U.S. companies is not the same as investing in the U.S. government.
Right.
Two very separate entities with their own financial situations.
Gotcha. Okay, so we've got this massive amount of debt held by a mix of domestic and foreign entities.
Right.
And one of the ways we often hear this debt talked about is in relation to the size of the economy, right? People talk about the debt to GDP ratio.
That's right, yeah.
Blah-blah.
It's basically a way to assess a country's debt burden. It's like you're comparing the size of the debt to the size of the economy.
Right.
Higher ratio suggests a heavier debt burden.
And where does the U.S. stand on that ratio?
Right now, it's hovering around 120%.
Okay.
Which means our national debt is bigger than our entire annual economic output.
Wow, that sounds pretty alarming. Does that mean we're headed for some kind of financial meltdown?
Not necessarily. The ratio is high, but you have to remember that it's not the only factor. What really matters is the government's ability to manage that debt specifically, their ability to pay the interest on that debt.
Okay.
It's kind of like having a mortgage.
Yeah.
The total amount you owe is important, but what really determines whether you can handle it is your ability to make those monthly payments.
To service the debt. So how is the U.S. doing on that front? Can we afford the interest payments on all this debt?
Well, that's where things get interesting.
Yep.
Some of the research that our listener sent in highlights that interest payments as a percentage of tax revenue have actually been a lot higher in the past.
Oh, really?
Even during times of strong economic growth. We're talking about like the 1980s and 1990s when the stock market was booming. So even though the debt itself is larger now, our ability to service that debt, to make those interest payments, might actually be better than it has been historically.
So the real issue isn't necessarily the size of the debt, but whether it's becoming more and more expensive for the government to keep up with those interest payments.
Exactly. And that's where things like, Treasury bond yields come into play. So the yield on a Treasury bond is essentially the interest rate that the government has to pay to borrow money for a certain amount of time.
Right.
The 10-year Treasury bond yield is a key benchmark that investors really watch closely.
And if those yields go up, it means the government has to pay more to borrow, which could put a strain on its finances, right?
That's right. And that could lead to like a ripple effect throughout the economy. You could see things like higher interest rates for businesses and consumers, which could then slow down investment and spending.
Okay, so let's play out that scenario. Let's say demand for U.S. debt falls significantly and those Treasury bond yields spike.
Okay.
What kind of impact could we see on businesses and just the overall economy?
Well, one immediate impact would be on bond prices. When demand for bonds falls, the prices go down. And when bond prices fall, interest rates go up. It's an inverse relationship. So essentially, it becomes more expensive for everyone, including the government, to borrow money.
So it's kind of a chain reaction.
It is.
Higher borrowing costs for businesses, which could mean less investment and potentially slower economic growth. And for consumers, higher interest rates could make it harder to afford things like cars and houses, especially those big purchases that typically involve financing.
Exactly. Certain sectors would likely be hit harder than others. Think about industries like auto manufacturing, real estate development, home building, those sectors that are really sensitive to interest rate changes and rely heavily on consumer spending.
Yeah.
They could see a pretty significant slowdown if borrowing costs rise.
And then there's the government's response to all of this. What tools do they have at their disposal to, try to manage the situation?
Well, one option is to raise taxes. If the government needs more revenue to cover those higher interest payments, they could look at increasing corporate taxes or income taxes that can help to, close that budget gap.
But wouldn't higher taxes just make things even tougher for businesses and consumers, especially if the economy is already slowing down?
It's a tricky balancing act for sure. Higher corporate taxes could cut into those corporate profits, potentially impacting companies that generate most of their revenue in the U.S.
Yeah.
But on the other hand, those multinational companies we talked about earlier, the ones that have those global operations, might be able to use international tax strategies to soften some of that impact. It's complicated.
Yeah, there's the potential for some unintended consequences there. What other options does the government have?
Another tool they could use is austerity measures,
Okay.
which essentially means cutting government spending.
Right.
That can help reduce the deficit and then slow the growth of the debt.
But those spending cuts would have implications for certain types of companies, right?
Absolutely. Companies that rely on government contracts, like defense contractors or infrastructure companies,
Right.
their revenue streams could dry up if those contracts are cut back.
Yeah.
We could also see impacts on healthcare providers and education companies if government spending in those areas is reduced. Austerity measures can have very far-reaching effects.
So it's not just about the debt itself. It's about all the potential chain reactions and how different parts of the economy could be affected. It's a very complex web.
It is. And one more consequence we need to consider is the potential impact on the U.S. dollar. If the government starts printing more money to try to finance the debt, that could lead to inflation.
Right.
And a decline in the value of the dollar.
And a weaker dollar would make imported goods more expensive, which could further fuel inflation, right?
Precisely. It can become a vicious cycle. But it's not all doom and gloom. A weaker dollar can actually make U.S. exports more competitive.
Oh, good.
Which could benefit certain industries.
Right.
And for those multinational companies that earn revenue in other currencies, they might see their profits increase when they convert those earnings back into U.S. dollars.
So there are potential winners and losers.
Absolutely.
In that scenario.
Yeah.
It's fascinating how all these pieces are kind of interconnected.
Yeah.
But speaking of the dollar, I've also heard a lot of talk lately about the U.S. dollar losing its status as the world's reserve currency, especially with the rise of, other economic powers like China. Some analysts are even predicting the emergence of a new global reserve currency, maybe backed by a basket of currencies from the BRICS nations: Brazil, Russia, India, China, and South Africa. What are your thoughts on that?
Well, there's definitely been a lot of speculation about the dollar's future.
Yeah.
But despite all the talk of decline, the U.S. dollar has actually remained remarkably resilient over the past decade. It's appreciated against most other major currencies and continues to be the dominant currency for global trade and finance.
So those predictions of the dollar's imminent demise might be a little premature.
Yeah, I'd say so. Creating a new global reserve currency is a huge undertaking. There's so many factors to consider. You have to think about economic stability, political influence, market depth. And no other currency currently comes close to the dollar in terms of meeting all those criteria.
Right.
The BRICS nations have certainly made some progress in recent years, but they still face some pretty significant challenges in terms of coordinating their economies and policies. It's unlikely that we'll see a sudden shift in the global currency landscape anytime soon.
So even though the U.S. debt is a major issue, it's not necessarily a guaranteed disaster.
Right.
And the dollar still seems to be holding its own on the global stage. But given all of these potential risks and uncertainties, it's definitely worth thinking about how to position your investments to potentially mitigate those risks. What kinds of companies might actually be relatively immune to a potential debt crisis in the U.S.? Are there any safe havens for investors to consider?
That's the million-dollar question, right?
Yeah.
And while there are no guarantees in investing, there are certain characteristics that might make some companies more resilient in this type of environment. One key factor to consider is a company's debt level.
Okay.
Companies with low debt and high cash reserves are obviously in a stronger position to handle economic uncertainty and rising interest rates.
Right.
They have more financial flexibility and are less reliant on borrowing.
It's like having a healthy emergency fund for a company.
Exactly.
They've got that cushion to fall back on.
Another important factor is the nature of their products or services. Companies that provide essential goods or services, things that people need regardless of economic conditions, are likely to be more resilient.
Right.
Think about utilities, healthcare, consumer staples, those essential items that people can't easily cut from their budgets.
Right.
They tend to be more stable, even during economic downturns.
Those are the must-haves, not the nice-to-haves.
Precisely.
I like that.
And remember we talked about the potential impact of austerity measures.
Sure.
Well, companies that aren't heavily reliant on government spending would be less vulnerable to those cuts. They're more self-sufficient and don't depend as much on government contracts.
So we're looking for companies that can stand on their own 2 feet.
Exactly.
So excited about it.
What about the potential for a weaker dollar?
Yeah.
Are there companies that might actually benefit from that?
Yeah. Are there any?
Yes. As we discussed earlier, multinational companies that generate a significant portion of their revenue overseas could actually see their earnings boosted if the dollar weakens. When they convert those foreign earnings back into U.S. dollars, they get more bang for their buck.
So a global footprint can act as a natural hedge.
Exactly.
In a way.
And lastly, it's worth considering companies that have demonstrated an ability to navigate complex tax environments, potentially taking advantage of those international tax strategies we mentioned earlier.
Right. Companies that are,
Yeah.
shall we say, tax efficient.
Right.
Okay.
Now, this isn't an exhaustive list, of course, and there are a lot of other factors to consider when evaluating investments.
Sure.
But these are some key characteristics that might help identify companies that are better positioned to handle the potential challenges posed by the U.S. debt situation.
Right.
It's all about looking for those companies with strength, resilience, and adaptability.
This is super helpful. So if we're looking for companies that fit this profile, are there any specific examples that come to mind?
Absolutely.
Okay.
A few that stand out based on these criteria are companies like Google, Microsoft, NVIDIA, Palo Alto Networks, and Meta.
Interesting choices. Let's unpack those a bit further. What about Google and Microsoft?
So Google and Microsoft, these tech giants, they have massive cash reserves, very little debt, and businesses that are so deeply ingrained in our daily lives.
Right.
Their products and services are considered essential by many,
Yeah.
which makes them less susceptible to those economic downturns.
They're almost like utilities at this point.
Mm-hmm.
It's hard to imagine a world without Google Search or Microsoft Office.
It's true.
Yeah.
They've become integral parts of our, digital lives, both at work and at home. And from an investment perspective, that kind of indispensability is incredibly valuable.
Right, exactly.
Yeah.
People might cut back on things like vacations or, dining out if times get tough, but they're not going to stop using Google or Microsoft products.
Right.
It's just not realistic.
And those companies have built incredible ecosystems around their core offerings.
Yeah.
Google has YouTube, Android, Google Cloud. It's a sprawling tech empire with so many different revenue streams.
Right.
And Microsoft has Azure, their cloud computing platform,
Yeah.
which has become a major growth driver for them. Plus, they're both constantly innovating and, expanding into new areas. Microsoft is making waves in gaming with Xbox.
Right.
And they're exploring the metaverse.
Yeah.
Google is pushing boundaries with AI and machine learning. These companies are not standing still.
Yeah, they're definitely not resting on their laurels.
For sure.
That kind of innovation and adaptability is crucial in the tech world.
Absolutely.
especially when you're, up against these other giants.
Absolutely.
Okay, so Google and Microsoft, two tech behemoths, diversified businesses, essential products and services,
Right.
and a real knack for staying ahead of the curve. They seem pretty well positioned to handle whatever economic challenges might come their way.
Definitely.
What's next on our list?
Next up is NVIDIA, a company that's been making a lot of noise in the semiconductor industry.
Okay, so we're moving from software to hardware. Tell me more about what makes NVIDIA so special.
Well, NVIDIA designs and manufactures graphics processing units, or GPUs,
Right.
which are basically the brains behind everything from gaming PCs to artificial intelligence systems to self-driving cars.
Those are the powerful chips that are driving, like, the modern digital world, right?
Exactly. And NVIDIA is really the leader in this space.
Wow.
Their chips are known for their performance and efficiency, and they're in high demand across a wide range of industries.
So even if the economy slows down, the need for these powerful chips isn't going to disappear.
That's right.
Right.
In fact, the demand for GPUs is only expected to grow in the coming years as artificial intelligence, machine learning, and other data-intensive technologies continue to advance. NVIDIA is riding that wave.
And NVIDIA is a global company, right?
Right.
So they're not entirely dependent on the U.S. market.
Right. They have a significant international presence,
Okay.
which gives them some insulation from any economic issues specific to the U.S. Their revenue is diversified across different regions.
So their revenue streams are diversified geographically.
Yes.
Okay, NVIDIA is definitely one to watch. What about Palo Alto Networks? They're in the cybersecurity space, right?
Yes. They specialize in network security, helping organizations protect their data and systems from cyber attacks.
And cybersecurity seems like one of those industries that's just going to become more and more important
Absolutely.
as cyber threats become more and more sophisticated.
It is.
Right.
As more and more of our lives move online, the threat of cybercrime is constantly evolving.
Right.
Companies and governments are investing heavily in cybersecurity to protect their critical infrastructure and sensitive data. It's a growing market.
It's almost like a digital arms race.
In a way, it is, and Palo Alto Networks is a leader in this space, developing and deploying advanced security solutions to combat these evolving threats.
So even if the economy takes a hit, companies aren't going to suddenly decide that cybersecurity is no longer a priority, right?
Right.
It's mission critical
Yes.
for most organizations these days.
It's a non-negotiable expense for a lot of companies, especially those that handle sensitive data.
Right.
And Palo Alto Networks is well-positioned to benefit from that trend.
Okay, so they've got that essential factor going for them, similar to Google and Microsoft.
Yeah.
What about their global reach?
They do have a global presence,
Okay.
which again helps to diversify their revenue and reduce their exposure to any single market.
Okay.
They're not overly reliant on the U.S. economy.
All right, so far we've got Google, Microsoft, NVIDIA, and Palo Alto Networks. All companies that seem well-equipped to handle a potential debt crisis here in the U.S.
Yes.
What's our final company on this list?
Last but not least, we have Meta, the parent company of Facebook, Instagram, and WhatsApp.
Meta has been in the news a lot lately, not always for the best reasons.
Yeah.
They faced a lot of scrutiny over things like privacy concerns, content moderation, and their, jump into the metaverse, which hasn't really taken off like they had hoped.
Right.
So, they're not without their risks.
No company is risk-free. Right.
But even with all of those challenges, Meta still have a lot going for it.
Okay.
I mean, they boast a massive global user base with billions of people using their platforms every day.
Right.
And they've been a dominant force in digital advertising for years. Even with the rise of new platforms like TikTok, Meta still holds a significant share of the market.
It's hard to deny their reach and influence.
Exactly. And they're not standing still either.
Okay.
They're investing heavily in artificial intelligence and other emerging technologies.
Right.
They're looking for new ways to monetize their platforms and create value for users.
So even though they're facing some headwinds, they still have a lot of assets working in their favor.
They do.
Yeah.
And they've shown a willingness to adapt and evolve, which is crucial in the ever-changing tech landscape.
It's really fascinating to see how all of these different companies, operating in such different industries, still share some of these common characteristics that might make them more resilient, in the face of economic uncertainty.
They've all got these strong fundamentals, they're innovating like crazy, and they have a global reach that really helps to diversify those revenue streams. It's a good reminder that even in, potentially challenging times, There are always opportunities out there for investors who are willing to do their homework and carefully consider all those factors that are at play.
Absolutely. It's all about identifying those companies that are built to last, the ones that can weather the storms,
Right.
and understanding that risk is just a part of investing. There are
Mhm.
no guarantees, but by focusing on quality, diversification, and informed decision making, investors can potentially mitigate some of those risks.
Well said. So as we move into the final part of our deep dive, I kind of want to shift gears a bit and talk about those sectors and industries that might be particularly vulnerable in a potential debt crisis.
Uh-huh.
We've talked about some of the potential winners,
Yeah.
but I think it's equally important to be aware of, the potential losers.
Right.
What are some of the red flags that investors should be looking out for?
That's a great question and one that deserves, careful consideration. As we've discussed, certain sectors are more susceptible to the potential fallout from a debt crisis.
Right.
These are often the sectors that rely heavily on borrowing, consistent consumer spending, or government contracts.
Right.
Knowing what to look for can help you make more informed decisions.
Okay, so let's break those down one by one. First, you mentioned companies that rely heavily on borrowing.
Hmm.
We talked earlier about how rising interest rates could really squeeze those companies that are carrying a lot of debt
Yeah.
on their balance sheets.
Hmm.
What types of businesses should investors be wary of in that regard?
Companies with high debt loads are definitely more vulnerable when interest rates are rising. These are companies that have taken on a lot of debt to finance their operations or expansion. As those interest rates climb, their debt payments get more expensive, which puts a strain on their profits and potentially even their ability to service that debt. It's a situation that can spiral pretty quickly.
So we're talking about companies that have really built their businesses on borrowed money.
Right.
They might look great on paper when interest rates are low, but they can become very risky when those rates start to rise.
Exactly. And these companies are often found in industries that require massive capital investments up front. Think about like energy companies.
Okay.
They need billions of dollars to explore for oil and gas, drill wells, build pipelines,
Right.
and refine those resources.
Yeah.
A lot of that investment is financed through debt.
Mm.
So as interest rates increase, their borrowing costs go up, making those projects more expensive and potentially less profitable.
And it's a similar situation for materials companies, right? The businesses that are involved in mining, processing, and transporting raw materials,
Absolutely.
they often have those huge upfront costs as well.
They do.
What about the real estate sector? We talked about that a little bit earlier.
Yeah.
Why is real estate particularly susceptible to rising interest rates?
Real estate is inherently tied to financing. Developers rely heavily on borrowed capital to build new properties, and then buyers typically take out mortgages to purchase those properties.
Right.
When interest rates go up, both developers and buyers are going to face higher borrowing costs, which can cool down the real estate market very quickly
Right.
and put downward pressure on those property prices.
Yeah, it's kind of a double whammy for that sector.
Yeah, it is.
Higher interest rates make it more expensive to build and buy those properties, which can then lead to a slowdown in demand.
Right.
It's a ripple effect that can impact that whole sector.
Exactly.
Okay, so let's shift gears a little bit.
Okay.
Let's talk about those companies that are heavily dependent on consumer spending.
Mm-hmm.
We talked about this earlier.
Yeah.
But I think it's worth kind of reiterating because it's a very crucial factor to consider, especially in times of economic uncertainty.
It is.
Because if the economy slows down and people start to really tighten their belts, those companies that rely on that discretionary spending
Yeah.
are really going to feel the impact.
For sure. And within consumer spending, there's a key distinction to remember
Okay.
between essential goods and services, which people tend to buy no matter what's happening in the economy,
Yeah.
and then those discretionary items, which are more susceptible to those cutbacks when times get tough.
Right.
Understanding that difference is crucial when you're evaluating companies.
Right. So things like groceries, utilities, healthcare,
Mm-hmm.
those are pretty stable because people need those things, no matter what.
Right.
But things like travel, entertainment, luxury goods, those are more vulnerable
Exactly.
because people can cut back on those if they need to.
That's a great way to put it.
So those companies that are really reliant on discretionary spending,
Mm-hmm.
like those retailers, restaurants, travel companies, those luxury brands,
Right.
they're going to be much more exposed to a potential economic downturn or a debt crisis that could impact consumer confidence.
Yes.
Those are the businesses that tend to see those first signs of trouble when the economy starts to wobble.
For sure.
And then finally, we have those companies that rely heavily on government contracts, the ones we discussed earlier.
Right.
these businesses generate a big chunk of their revenue from government spending. And they could be really vulnerable if the government is forced to tighten its belt.
Exactly.
Right? We talked about defense contractors, infrastructure companies, healthcare providers, education companies. If the government starts implementing those austerity measures to address a debt crisis, those companies could see their revenue streams shrink as contracts are cut or delayed.
That's right. Their fortunes are very closely tied to government spending, which can be unpredictable,
Yeah,
especially during those times of economic stress.
yeah. It's something investors need to be mindful of.
Absolutely.
This has been a really insightful conversation. I think our listeners are starting to get a much clearer picture of, like, the potential ripple effects of a U.S. debt crisis and how it could impact, different sectors and businesses.
I agree. It's been great to really unpack these complex issues and shed some light on the potential risks and opportunities.
So to wrap up this deep dive, I want to circle back to what we discussed earlier about informed investing. Knowledge is power, especially when it comes to navigating uncertain times.
Right.
We've covered a lot of ground today, from understanding, the nuances of the U.S. debt to identifying potential winners and losers in different sectors.
Yeah.
But what's the key takeaway for our listeners? What should they be doing with this information?
I think the most important message is to stay informed,
Okay.
be proactive, and don't be afraid to ask questions. Keep up with the economic news, understand the factors that are driving market trends, pay attention to geopolitical events. The more you know, the better prepared you'll be to make smart investment decisions.
And remember, there's no one-size-fits-all approach to investing. Everyone's financial situation is different, and what works for one person might not work for another. It's important to do your research, consider your own risk tolerance, and maybe even consult with a financial advisor to create a strategy that really aligns with your goals.
Absolutely. And diversification is key. Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes, sectors, and geographies to potentially reduce your overall risk.
And focus on quality.
Yes.
Look for companies with strong balance sheets, solid earnings, and a history of navigating economic challenges.
Right.
Those are the companies that tend to weather the storms
Yeah.
and come out stronger on the other side.
This has been a fantastic discussion.
Yeah, I agree.
I think we've provided our listeners with a lot to think about.
I agree. And on that note, I want to thank everyone for tuning in to the very first episode of Bull and Blum. We hope you found it informative and engaging.
Thanks for having me, Max.
It's been a pleasure.
We'll be back soon with another deep dive into the world of finance and investing. Until then, happy investing, everyone.